So probably one of the most fundamental questions that you're going to have for your business is, how do I organize? And really, how you choose to organize is going to have both tax and legal implications. And so it's really important that you understand what they are and you understand how they might impact your business. And so I think in this lecture, I'll probably add like a lot of anecdotal information, not that I don't regularly, but this one kind of needs it a little bit more just for that reason. Like I said, tax and legal implications. Frequently when you go out and you ask for advice, what you might get is somebody who is a tax specialist giving you legal advice and somebody who is a legal specialist giving you tax advice. And so, like I said, it's really important for you to understand your business and what you may or may not need. So the most common form of legal organization is what we call the sole proprietorship. A sole proprietorship is a business owned by one person or a couple or significant others. And just by operation of law, most businesses are sole proprietorship, because if I go and buy a bunch of sunglasses and I go out and sell them on the beach, by operation of, and I do nothing else, by operation of law, I'm a sole proprietorship. That's why over 99% of businesses in the United States are sole proprietorships, because they are just people who are out there doing business, for lack of a better term. Sole proprietorships are simple to set up. You may or may not need a business license. And if you are doing business using a business name that is something other than your legal name, at least in California, you need what's called a fictitious business statement. Is anybody going to chase you down for that? Probably not, at least not right away. If you open a bank account, you will definitely need a business bank account. You will definitely need a fictitious business name. So the advantages of sole proprietorship, besides the fact that they're easy to set up, include the fact that you receive all of the company's profits. Hang on, I got an itchy nose again. Why is it that when I make these videos, my nose always itches? Drives me nuts. So you receive all of the company profits. You own all of the company's assets. So anything owned by the company is owned by you. You can easily transfer ownership of the company name and assets. You just, transfer the assets. So when you sell a sole proprietorship, you're basically selling the assets, and then you add on a price for what's called the blue sky, or your reputation. So it's very simple. There is no registration or filing fee unless there is a business licensing fee by your city. And because you are the business and the business is you under the eyes of the law, you are free from interference from anyone else. When you start up a sole proprietorship, you can't have investors. And so what that's might be bad, but in some ways, because you can only fund through your personal savings and through getting a loan. However, you get 100% of what I call the say-so, because you get to make all of the decisions. There are some pretty significant disadvantages to a sole proprietorship, though. First of all, the business bears all of the risk. If I own a sole proprietorship and somebody comes into my sole proprietorship business and injures themselves, and they sue me, that means that my sole proprietorship is being sued, but I am also being sued. And so my house, all of my assets, anything that I own is subject to forfeiture as a result of my negligence. And so what that means is that somebody sues me, they can come and take all my stuff. And so there is what we call unlimited risk with a sole proprietorship. I'll talk about how to mitigate that in just a minute. The sole proprietorship is subject to the claim of all of the creditors. If there is a creditor against if somebody's collecting a bill against my sole proprietorship, they're collecting a bill from me. And so if my business can't pay the bill, they can look to me personally to pay the bill. There is unlimited personal liability for the business. Like I said, anything that's owned by the business is owned by me. And so all of my personal things are at risk. You don't get any tax benefits as an employee. Sole proprietors pay what's called self-employment tax. And basically what that is when you get a paycheck from an employer, your employer is paying Social Security and Medicare tax. What you don't realize is you're paying half and they're paying half. And so there's a deduction from your check, but the other amount is coming from them. And so as a sole proprietor, you have to pay both the employer and the employee portion of that check. So that's what we refer to as self-employment tax. Death or incapacity of the owner terminates the business. So there's no kind of survivorship of a sole proprietorship. It's limited to the proprietor's personal capital. In order to fund a sole proprietorship, like I said, you're limited to your personal savings and your ability to get a loan or a grant or something like that. And your sole proprietorship income is taxed your business income is taxed as personal income, which isn't necessarily a disadvantage in my mind, but it could be. So quick thing about sole proprietorships. Does that mean that I shouldn't have a sole proprietorship? And the answer is no. First of all, what you can do as a sole proprietor, let's say that I have an ice cream shop, okay? And I want my ice cream shop to be a sole proprietorship. Now, personally, I wouldn't do that, but for whatever reason, you want to be a sole proprietorship. What you can get is called a general liability policy or a blanket policy, and you pay a couple $100 a year, and you've got $3 million, $5 million, $10 million of liability coverage in case something happens in the scope of your business. The second thing is that if you have a type of business where risk is mitigated, so if I'm doing, for example, content marketing, there's not a whole lot of risk in content marketing. I'm making something for somebody and I'm selling it, basically. That's what you're doing. And so because there's not a whole lot of liability associated with that, I think being a sole proprietorship is just fine in that case. So the question about should I be a sole proprietorship is really about how much risk is involved in the type of business that I'm doing. I would tend to say that if you're dealing a lot with the public and you have an establishment where the public is coming in, then you definitely want to be something other than a sole proprietorship. A partnership is basically a sole proprietorship divided by the number of partners. By operation of law with a partnership, if you don't have a partnership agreement, the law assumes that it's an equal partnership. So if there's 3 partners, that means that it's 33 1/3 for each partner. If there's 2 partners, it's 50-50. If there's 4 partners, it's 25%. In order to be a partnership, you have to be of legal age to contract, which is 18 in the United States. Ideally, you also want to have somebody who's honest, healthy, capable, and ultimately compatible with you, somebody that you can work with. I don't love partnerships, and here's why. A lot of times people go into partnerships with their best friend or their boyfriend or their girlfriend, whatever it might be, and partnerships are like marriages. You're working together all of the time, and they don't have all of the kissy love and affection that marriages have. And so they tend to fail at a much higher rate. And so what you really need to vet with a partnership is, what is our concept? Do we really need to be partners, or should it just be my business and you're my employee? So you need to think about that, especially if you have partners who are coming in with unequal capital amounts. I'm coming in with $100,000, my partner's coming in with $10,000. Should that person really be my partner, or should they just be an employee? So there's that. Oh, itchy nose again. Sorry. Okay, how are we going to structure our ownership? Are we 50-50? Are we 70-30? Whatever, if it's something other than 50-50, it needs to be written out, and you need to have an agreement. Why do we need each other? I just mentioned that. Do you need a partner, or do you need an employee? And then probably the most important thing for me is lifestyle. Maybe you go into a partnership with your best friend and you're at a phase of life where you're willing to put 80 hours a week into the business, and so is your best friend. And then your business progresses, and maybe you start doing well, and then maybe you want to have a social life, and maybe you meet somebody, and maybe you want to have a family, and then maybe your priorities change. And for one partner, the priorities are changing, and then for the other partner, they still want to work 80 hours a week on the partnership, and they're wondering why you aren't either. And so that kind of stuff can make partnerships really difficult, which is why I tend to not love them as an option. If you are going to go ahead and go through with a partnership, you definitely, in my mind, need to have a partnership agreement that explicitly lays out what everybody's going to do, what they bring to the table, and what they are responsible for. One more thing about a partnership is each partner has agency over the partnership. And what that means is the partners have the ability to tie the partnership to legal agreements that the other partners may not want. For example, let's say that we have my sunglasses, my lovely sunglass company here, and I want to sell my sunglasses in high-end boutiques, and my partner wants to sell them at Walmart. And so my partner goes behind my back and signs a contract with Walmart. Well, now I am going to be selling my glasses in Walmart because they have tied me to Walmart as a partnership. Sorry, I forgot to turn off my email, so that email notification that you're hearing is not yours, it's mine throughout the lecture. Moving on to, and then partnerships are taxed in the same way that a sole proprietorship is. So it's just the profits are divided equally among all of the partners, or according to the partnership agreement. A corporation is kind of designed, that was my email again. A corporation is designed to solve the legal issue of how to deal with that whole concept of unlimited liability. And so what a corporation does is a corporation exists to create a liability shield for whoever, for lack of a better word, owns the corporation. So it is a business organization that exists as a legal entity to provide limited liability for its owners. So what that means is the corporation is a person under the eyes of the law. So there's you and your corporation. And so there is this invisible shield that is set up by the law that creates liability protection for you because your corporation is what holds the liability. So it has a separate legal existence. It is known as an artificial being. It is brought to life, hold on a minute, by articles of incorporation. So you file articles of incorporation with the Secretary of State once, and you have to lay out a whole bunch of things, name of the company, why you're doing business, the number of shares, all that kind of stuff. There's a lot to getting a corporation set up. So it's born, it dies through dissolution. Okay, there's a dissolution process for a corporation. And then the corporation, just like any other person, has to pay taxes every year. Most corporations, by operation, if you just start a corporation, you're starting what's called a C corporation or an ordinary corporation. That is a corporation that is chartered by the state that you're doing business in and taxed by the federal government as a separate legal entity. Do you have to start a corporation in the state you are doing business in? Technically, no. You can start a corporation in pretty much any state. Some states have a requirement that you do business there as well. Most don't. I have a Utah corporation that does require me to have a Utah address. And I have a California corporation as well. Do I just have two right now? I have two, yeah. And so corporations are not owned by business owners, they are owned by shareholders. A shareholder is somebody that owns stock, or a stockholder is another word. So what happens with a corporation is that when your articles of corporation, you dictate how much stock you're going to have. And basically what that means is if you think of a company as a whole, your business as a whole pie. The stocks are, when you file to the corporation, it's going to break up your pie into tiny little pieces called shares. And so what you can do as a corporation is you can sell a little piece of those shares to investors. And so an investor then can come in and help capitalize your business, and they get a tiny little piece of ownership. So each shareholder or stockholder owns a little piece of your business. As a business owner, what you need to understand is when you sell shares, you're giving up a piece of control of your company. The shareholder their ownership is limited to their investment in the company. So when I buy 50 shares of Disney and Disney does something horrifically wrong, the most that I can lose is the value of my 50 shares. What's great about stock and corporations is that ownership, I can sell my shares without impacting the company's operations. And people sell stock all the time. Let me just talk really quickly. Let me see. Do I have anything about the, yeah. Wait, do I? Okay. Yeah, I'll talk about that in a minute. Where am I? There I am. Okay. So corporation, sole proprietorship, partnership. How do I determine what form I am going to choose? First of all, cost. When you decide to go the corporation route, you have to pay to incorporate. You also then have to pay fees every year. When there are also corporate formalities that you have to keep, such as having a shareholder meeting, keeping a minute book, things like that. I'm going to talk about a couple of additional forms of corporation in a couple minutes that kind of alleviate those issues. Do you want to protect your liability, or do you want to have unlimited liability? So protecting your liability would be going the corporation route. Unlimited liability would be the sole proprietorship route, unless you do some kind of insurance policy. The continuity of the business, it is much easier to continue a corporation just because all you have to do is sell the shares. With a sole proprietorship or a partnership, it's a bit more fuzzy because the sole proprietorship is going to die with whoever owns it. Transferability of ownership, corporations just sell the shares. Sole proprietorship, you're just selling the assets in the blue sky. Same with partnership. Management control, you have more control over a sole proprietorship than you do over a partnership or a corporation if you've sold stock to shareholders or if you have investors. Attractiveness for raising capital. If you want to raise funds from investors, then you have to be a corporation. If you are a sole proprietorship or a partnership, you're limited to personal savings and loans and grants. With a corporation, you can do personal savings, loans, grants, and you can get investment. And then income taxes. Sole proprietorship, very simple. Partnership, very simple. With a corporation, you are going to be taxed differently. I'm just going to skip down to the bottom bullet there. So corporation, unlike a sole proprietorship or a partnership, is a separate legal entity. And so what that means is when the corporation makes money, it has to pay taxes on its income. And so your corporation pays taxes, and then you, as an employee of the corporation, get a paycheck, and then you have to pay taxes on that money that you get as an employee. And so this concept is known as dual taxation, because if my sole proprietorship makes $100,000 and I'm at a 10% tax rate, then I'm going to pay $10,000 in taxes and I'm going to keep $90,000. If my partnership makes $100,000 and I'm at a 10% tax rate, each partner is going to get, what's my math here? Each partner pays $5,000 in taxes, and then they get to keep $45,000. If my corporation makes $100,000, my corporation has to pay tax at a corporate rate. Let's say, for lack of better terms right now, let's say it's 20%. Okay, so my corporation pays $20,000 in taxes. $80,000 comes to me in a paycheck. Do I get to keep that $80,000? No, because I have to pay taxes on that $80,000. And so I pay $8,000 in taxes. And so my $100,000 that my corporation made now in my pocket is $72,000, as opposed to my sole proprietorship where it's $90,000. So that is the dual taxation of a corporation, which might make you think, this does not sound fair. And the IRS agrees with you. And so I'm going to skip to the S corporation. And so one of the things that the IRS did was they create a special Part S corporation. And an S corporation is a small corporation that gives you the tax structure of a partnership. So you're taxed as a partnership, and you have the liability coverage of a corporation. In order to be an S Corp, you have to be small, so you can't have no more than 100 shareholders. All stockholders have to be individuals or trusts, so you can't have a corporation hold stock in another S corporation. That's not allowed, where you can do that in other forms. You can only have one type of stock. You have to be domestic, which means that you have to do business in the state where you're organized. You have to operate on a fiscal calendar year basis, which means that you have to have a start date and an end date that is the same every year. A lot of times it's January 1 to December 31, but it's different for different industries. And everybody has to be either a U.S. Citizen or a green card holder. So it limits foreign investment. The benefits of being an S Corp is that your liability is limited to your investment in the corporation, so you have that liability protection coverage, and you've avoided dual taxation. What was I going to say else about S Corps? S Corps. Oh, the one thing about S Corps, though, is because I said it was a partnership, there's no flexibility in the shares. So if I say that my S Corp has 3 partners and we're all 33 1/3, in perpetuity, we're going to be 33 1/3. If one of the partners wants to take a sabbatical and says, you guys can have my profits for the next 6 months, on paper, the IRS will not let you do that, or the rules of S Corps won't let you do that. And so there is some inflexibility in that. Really quickly, in terms of another legal form that is frequently used for partnerships is what's called a limited partnership. And a limited partnership is where you have one partner who is the active partner in the business. That person is going to be the party who is personally liable for debts of the business. And then limited partners are investors. And so they're not active in the business. Their contribution to the business is money. And with a limited partnership, what the amount that you can potentially lose is just your investment in the business. So it's like being a shareholder. Limited partnerships are not common in most of the types of businesses that our class is dealing with. If you're into real estate or investing in other businesses, then you might wind up in a limited partnership at some point. So another specialized form of organization is the limited liability company, or LLC. An LLC is a corporation where stockholders have limited liability, but they pay personal income taxes on the business profits. So with an LLC, they are super easy to set up. The shareholders are referred to as members. And they tend to be very flexible. My LLC can function as a partnership. It can function as a sole proprietorship. It has a lot of flexibility in the way that it's organized. And so there are very specific tax advantages to LLCs that don't really work for sole proprietorships or corporations. What you need to know about an LLC, though, is so the LLC, my LLC cost me $800 a year in California, no matter whether I do $1 of business or $100,000 of business. So once you make the decision to go with an LLC, you need to be sure that you're willing and ready to spend $800 a year for the privilege. For most of you guys, I would say that that is a not great idea until your business is up and running and you are making consistently, pretty good net income of maybe like $1,000 a month or more, because that $800 is, even with my business, I'm never happy when I see that come out of my account. Now, my Utah LLC costs me $31 a year. And so different states have different costs for their LLCs. But with my Utah LLC, it's only $31 a year, but I also have to maintain an address in Utah. I have like a mailboxes, etc. type address that I pay another like 150 or 200 bucks a year for. And then anytime I get mail there, they charge me to send me the mail. So LLC is different in every state. It's important to know like what ones work for you. I really do like my California LLC. I wish it was a little bit cheaper. My Utah LLC is great, but it's in Utah, so I have to deal with that. But you know, everything's a little bit different. Some specialized forms of organization that you may or may not have heard about. A B Corp is a corporation that incorporates a traditional for-profit model with a identified social or environmental benefit. It tends to be more of a certification than anything else. But the cool thing about a B Corp is that shareholders can hold directors accountable for failing to create that positive benefit that they say that they're going to make whatever it's going to be. Some examples of B Corps. Athleta, the athletic apparel company, Patagonia, another athletic apparel company, Kind Bars, any kind of healthy type product. I see some Myers soap. Hold on a minute. Let me see if this Myers soap is a B Corp. I'm sure it is. No, it's not. Okay. Well, let's pretend that this Myers soap here is a B Corp. If something is a B Corp, you'd see it down here. It would say B Corp. Yeah, it doesn't say B Corp, but it would be down here. Okay. A low profit limited liability company, or an L3C. I'm not quite sure why I'm talking about that because they're only legal in 9 states, and one of those states is not California. But L3Cs are designed to further a charitable purpose, and they're not allowed to significantly pursue financial returns. So if you think about like an Oceanside, the DAV, right? So the DAV, you can donate stuff, and then they sell stuff in the thrift store to help run the charity DAV that takes care of disabled veterans. So the thrift store portion is operating like a low profit company. They are doing what they are doing to drive that mission of taking care of people. And so that would be an example of a company that fits like an L3C mold. Like I said, they're not legal in California, so that's probably not an L3C, but I just wanted to give you that example. Whew. All right, so some concluding thoughts. Please, 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 please don't spend the money to create an entity that you don't need. Wait until you need one. Most of us are going to be okay with sole proprietorships. Some of us will need an LLC, but definitely not all of us. If you're taking pictures and your business is photography, you don't need an LLC. Your decision will impact your cost structure, your taxes, your liability, and possibly your success. If you're outlaying that money for an LLC when you don't need to, that can impact your success because that's $800 every year that could be going into your business. So do your research and make the decision that is right for you. And I hope that this lecture helped with that.